Rajiv Das. Let's talk about some of your favorite closed-end funds over at Bulldog Investors. And the first one is the NUVEEN Global Equity Income Fund. The ticker is JGV. It's trading at about a 12.5% discount, which is a little bit more than its three-year average. Why do you like it?
Well, this is a global value fund where managers look to buy assets trading below what they consider the intrinsic value. We actually started buying the fund in the summer of 2015 when the discount had widened out to over 15%. It's got a good shareholder base. We own over 8% of the shares. There's another large shareholder with another 8%. We've given management notice that we intend to run directors at the next annual meeting, and we've also asked them to provide opportunities for shareholders to exit at net asset value. Because of all this, the discount has actually come in to about 12%. But I think if we are successful, we can see that discount a lot narrower. The annual meeting is scheduled for April of 2016. So you're really talking about holding this fund for another 2 to 3 months before you could see some real action happening on the discount.
And you're also bullish on the First Trust Dividend and Income Fund. This one has about 25% in leverage. It's trading a little bit below its three-year average discount. But that leverage scares a lot of people, especially with the Fed at least talking about raising rates.
Yeah, it's all about managing risk in your portfolio, and I think you'd have to see where this fits in within that context. We like it because, again, it was at a wide discount. We bought these shares originally at about a 14 or 15% discount 6 months ago. We own over 13% of the fund. The discount actually was, a couple of months back, was even narrower than where it's at now. Because of our filings. We've given them notice and we intend to run directors. The shareholder meeting is at the end of March. So again, you're talking about holding a fund for about 2 months and you could see real compression on the discount. The leverage, 20% of the fund is in senior loans. The rest of the fund is large cap names like JP Morgan, Wells Fargo. They're overweight financials. So if rates do go up and banks start increasing their net interest margins, you could see good performance on the portfolio too. So I think, with the discount, we think really on a fund like this, which is so small, it's only about a $70 million market cap. There's not much that management can do other than really, liquidate the fund or offer shareholders a full exit. So in addition to what the market's going to do, you should see discount compression go from, we think, from 9% to 0. So that would be added alpha over whatever the underlying portfolio gives you.
All right, next is the NUVEEN Long Short Commodity Fund. This one's at a discount of around 4% versus 10%, which is the three-year average. So why do you want to own this one? Because it seems like it's headed in the right direction. Yeah, it is. This is an interesting fund. At first, NUVEEN issued this fund back in 2012. It was over $500 million fund. Came out at a premium, traded at a premium for the first 6 months, and then went to a discount. It's never traded back at par again. In fact, it had gone to a discount of over 22% a couple of years back. When that happened, NUVEEN decided to convert the fund from a closed-end fund to an ETF to get rid of the discount and better align the market price to the underlying NAV. The board of directors has approved it. Shareholders have approved it. It's just a matter of going through regulatory hurdles. So that 4% discount that you see now is going to go to 0. The underlying portfolio is hedged. So last year when commodities were down, if you look at a iShare ETF, about 34%, this fund's NAV was down about 1%. So we think that you have a very safe NAV. You're not going to see much movement on the NAV, and that 4% discount is going to compress to 0 in about 3 months. So, that's about a 16% IRR annualized with very little market risk. All right, got 2 more. The next one is the Managed High Yield Plus Fund. The ticker is HYF. Everyone's screaming at a high yield right now. This one has 33% leverage. Why do you want to own it? Well, again, it's not about forecasting where the high yield markets are going to go. Our goal is to generate alpha over an existing asset class. So this is a fund that's run by UBS. UBS has decided to get out of the closed-end fund business in the U.S. They've announced the liquidation of 3 funds, and a 4th fund that they manage is converting to an open-end fund. So this fund with a 4% discount, a shareholder meeting is in April, where shareholders are being asked to approve the liquidation of the fund. So you're going to see this 4% go to 0. And that's why we like this fund. All right, and then finally, the LMP Real Estate Fund.
Okay, so this is a REIT fund. We originally bought this fund back in September of 2014 at about a 14 or 15% discount. We gave notice to the fund that we intended to run directors. In 2015, we did run a proxy fight. No quorum was reached, so the existing directors held over till 2016. We continued to buy shares. We now own over 20% of this fund. The reason it's at a 4% discount is because the LMP, that's the managers of the fund, announced that they would open-end the fund. So in the second quarter of this year, you're going to see this 4% discount go to zero. There's a 1% fee to exit. But again, it's about achieving alpha over the asset class. If you had owned this fund in 2015, you would have made about 10% on this fund because of discount compression versus 1.5 or 2% on a REIT ETF.
All right. Well, thanks a lot, Rajiv.
Thanks for having me.
And thank you for watching The Street.